I want to talk about interest rates today, or more specifically, I want to talk about the potential impact that government debt can have on long term interest rates. And why I'm bringing this up, there's been several recent studies analyzing the potential impact of U.S. debt on long term bond rates, long term mortgage rates. And so I'm gonna highlight some of those studies today and just give you a heads up because it's critical that we have really good basis for how we advise our clients. And we can't just be wishful. We can't live in a echo chamber that tells us what we want, but we have to be a little bit better informed so that we can give a very well balanced opinion and advice to our clients. And so this is just going to be one more view of how interest rates might behave. Now, we're conditioned to pay attention to inflation, and certainly we're hearing a whole bunch of news from the president trying to help bend short-term interest rates. Of course, we saw last year where the Fed cut short-term interest rates by 100 basis points while long-term interest rates increased by 100 basis points. So the market really determines what happens. But what I want to talk about specifically is the impact that government debt has on interest rates. Now, none of this is going to be opinion on whether that debt's good or bad. None of it is going to be an opinion on whether the CBO's, scorecard on debt is correct or incorrect. I'm not really I don't really care about those things. What I want to talk about is how structurally debt can impact interest rates. And so to do this, I'm really relying on Dr. Torsten Slok's recent study from Apollo Management on this, and he had a recent article, so I'm really borrowing from that quite a bit. But in the article, he published this chart, and this chart lists a handful of recent studies that have estimated the impact on U.S. debt. And here's the bottom line. The bottom line is for about every 1 percentage point in government debt to GDP, it raises long-term interest rates by about 3 basis points. The studies vary from 2 to 4 basis points, but the consensus is 3 basis points. So let's say I think we're at a little bit over 100% of U.S. debt to GDP. Let's say it's 100%. If it goes to 101%, that puts about 3 basis points pressure on long-term interest rates. And why that's important is recently the CBO just scorecard the upcoming the big beautiful tax bill. I'm sorry if I'm getting that right, but the bill, it's actually Public Law 119-21, which is the new tax and spending package, and that the CBO scorecarded it to create an additional $3.4 trillion in deficit over the next 10 years. Now, that may or may not be true. Frankly, the CBO, who has to use static analysis, has always been wrong. It hasn't estimated enough debt. Debt's grown much faster than the CBO argues. So that number could be totally wrong. Conversely, some economists, could argue or do argue that look, the CBO doesn't have it because it's using static, not dynamic scorecarding. It's not going to account for all the added revenue that's going to come in because of these tax cuts, and so that the tax cuts pay for themselves. I don't have a position on that. Like I said, I don't care about that. But hypothetically, if the debt were to increase by $3.4 trillion over 10 years, what that means, it's going to naturally put about 60 basis points upward pressure on long-term rates, if we believe these studies I just shared with you, right? Because it's going to increase the debt to GDP by about 20%, roughly 20%, and that equates to 60 basis points increase in rates. And so even if inflation were to come back underneath that 2% level, and even if the Fed starts cutting short-term interest rates, there's going to be pressure on long-term rates. Now, heck, this all may happen, it may not happen, but it'll be good to be informed on the different impacts to interest rates. So we no longer should just say, heck, we think inflation's coming down. By the way, I don't subscribe to that, but we think inflation is coming down and therefore rates are going to come down, or we think the Fed's going to start cutting once, twice, three times this year, once, twice, three times next year, and so rates are going to come down. Both of those are probably false, by the way. They're probably false. And if we want to be trusted advisors, we have to probably give better advice. We cannot give bad advice or else we lose the trust. And as we lose our trust, we lose our ability to charge our clients. And so we just need to be really well informed. And so we can give a well-rounded. We can say we think inflation is going to improve, and that should help short-term interest rates come down, which could put downward pressure on long-term rates. But we also know that there's added debt. There's a lot more supply coming to the market that might offset that put upward pressure on rates. And so more than likely, we need to qualify people with our advice that, hey, we're living in a 6 to 7% world, most likely, and that let's make sure that this transaction works for you now at that rate. So I posted an article on this on LinkedIn today. Now, when I say an article just means that my LinkedIn post couldn't fit the restricted 3,000 characters, which forces it to go into an article. But I did a pretty lengthy article on this, explaining the impact of possible government debt on interest rates. I cited these 4 studies. I also, in my article, cited and provided a link to the Federal Reserve working paper titled "Revisiting Interest Rate Effects on Federal Debt." It was written by the Dallas Fed. It was published just a couple months ago. I put links to that in my LinkedIn article. So check out the LinkedIn article. Consider this when you're advising clients. It's certainly, and as I always say, adopt an economist. Quote one of these economists. So quote Thomas Laubach or quote Torsten Slok. Quote one of the economists. So you're leveraging their expertise and you're not putting yours at risk. But anyway, I hope you got something out of this. I appreciate you giving me some of your time. Make sure you check out my LinkedIn. Check out this article. And with that, I look forward to talking to you again soon. Thanks.